2024 approaches with a welcome pause in RBA rate hikes and clear signs that the economy is slowing, but a challenging period ahead. Our latest thoughts on the cusp of the new year. The December RBA no-change policy decision and associated comments were as expected and maintained the tightening bias, but did add weight to a rates on hold scenario, potentially for all of 2024. Another hike to 4.6% can't yet be ruled out and will be dependent on the quarterly CPI data out in late January and then in late April. But equally, rate cuts will need a lot of progress with inflation to materialise. The latest GDP numbers showed the economy is quickly decelerating. Real GDP only rose 0.2% in the third quarter, and GDP per capita fell 0.5%, leaving us in a per capita recession. Household consumption and savings rates continued to slow, and only public demand and capital investment kept the economy growing last quarter. So, with the November rate hike and the likely easing in population growth next year, the risk of a technical recession is still real. Fortunately, the resilience in labour markets continues to insulate households from the slowing in the economy. But next year, the unemployment rate is expected to steadily rise. As the chart shows, unemployment typically rises as job advertisements fall, amid tight labour markets losing their strength. And the latest fall in the ANZ Indeed jobs ad series and other employment reports does suggest that this is well underway. The updated RBA forecast is for unemployment to only reach 4.2% next year. But as detailed on our Business Insights website, our forecasts show a sharper rise to above 4.5% by mid-year. Further economic data to be released in the coming months is expected to show a similar theme. Higher interest rates, on top of the cost of living crisis, slowing the economy down, suggesting further RBA hikes may be unnecessary. Meanwhile, a range of other central banks, including the US Federal Reserve and the European Central Bank, may well be cutting their rates by mid-2024. But for the RBA, the key is how quickly inflationary risks subside. Core inflation has peaked and is expected to keep falling. But for the RBA to cut rates, they'll need to be convinced that the target of 2.5% is both achievable and imminent. Goods inflation is likely to be around that target relatively soon, but core services inflation may need all of next year to normalise. That contrast between the likely timing of US rate cuts versus the RBA is flowing through to currency markets, with the Aussie dollar reaching almost 67 cents, in line with US dollar weakness. Elsewhere, equity markets have recovered on the prospect of US rate cuts, and the price of gold has just reached a fresh record high. But market confidence remains fragile. In summary, 2024 is likely to be a year where our economy slows further under the weight of higher interest rates, setting the scene for rate cuts early in 2025, but that timing dependent on CPI continuing to moderate and core inflation falling below 3%. And that's the market update from Bendigo Bank, with best wishes for a safe and peaceful holiday season.